Hello and welcome to my YouTube channel, The Corcoran Codex. The focus of this channel is to look at key features of the global capital markets, and in this video I want to take a big picture look at the foreign exchange market, which is probably the most liquid of all the financial markets. If you are a first-time visitor to this channel, I hope that you will then decide to subscribe to the channel. That way you can be notified of all new videos that I produce, which I do fairly frequently. If you are a returning visitor, then welcome back, and I hope you will enjoy the coming video. The FX market is an example of a decentralized market. It operates 24 hours per day, starting from Monday morning in Asia and concluding on Friday afternoon, evening in North America, primarily US. There is no centralized trading exchange or venue as such, but the market is conducted in a sort of peer-to-peer fashion where a network of nodes basically connected by ECNs, for example, Reuters is quite active in this area, bring about a peer-to-peer network. There are three main types of transactions conducted in foreign exchange. Spot transactions. These are immediate deals done, let's say, between two banks, two different nodes on this network, and based on the current exchange rate on the screen. These are typically settled within 2 working days, or they could be rolled over. There are what are known as forward transactions. Now, these essentially involve deals where an exchange rate is specified right now. It is a rate that can be calculated as of right now, and it applies to some actual exchange of the two currencies at some point in the future. And then there are a series of derivative transactions in FX, including swaps, options, futures, and various other structured products. Most of the active participants in the global FX market are the major banks, and I think it's fair to say that most of the activity that they engage in and conduct essentially is pure speculation, trading one currency against another, where the bank is essentially taking a P&L risk. Let us now turn to discuss the size and scope, really, of the global FX market. And what I'm going to refer to is a document that you can see on the screen here. This is the Triennial Central Bank Survey. This is conducted and put together by the Bank for International Settlement, a body based in Basel, Switzerland, and they conduct this survey on a triennial basis every 3 years. The most recent was conducted as of April 2025, and the report was published here in September of 25. So I'm going to look back at each of the surveys done in 22, 2019, all the way back to 2010, and we can actually get a sense of the size of the market. As of April 25, the size of the market on a daily average basis is about $9.6 trillion, a rather staggering amount. This had grown from about $7.5 trillion in 22, and if we go back here to 2010, we can see that the market's turnover back then was around $4 trillion. So we've seen a steady increase over each of the 3-year periods when this survey is conducted. And as I say, the most recent data shows that the market had an average daily turnover of about 9.6 trillion. This shows you the FX turnover by the different instruments, which I discussed just a moment ago. So as we can see here, this is the 2025 data. Here is the last survey back in 2022. And what can we see? Well, 31% of the transactions were based in the spot market, 19% were in the outright forwards market, and 42% in the FX swap market, 2% here for currency swaps. I'll discuss briefly what those are later, and options and other products amounting to about 7%. And we can see that this has changed somewhat from the 2022 data. The size of the swap market has contracted from 51 down to 42%. This has expanded somewhat. This also, and we can see the change over here for the options and other products. And over here on the left-hand side of the screen, we can see the total turnover. So this is around 2 trillion back in 2004, moving up steadily. And as we saw just a moment ago, the total net turnover in FX on an average daily basis is this 9.6 trillion number that I mentioned just a moment ago. Now, in the survey, the BIS talks about when and where FX trading takes place. So as of the most recent survey, April 25, sales desks in 5 locations, UK, US, Singapore, Hong Kong and Japan, account for 78% of all FX trading. The share of trading taking place in the US increased slightly from 19% in 22 to 20% in 25. The UK remained by far the most important FX trading location globally, with 38% of global turnover. And the trading in the Asian markets declined slightly to 20%. Now, let's have a look at the diagram here, which effectively shows you on a 24-hour-a-day basis the kind of rhythm, if you like, of trading in FX. It's based on London time, which, as we just saw a moment ago, the UK is the central hub really for trading of foreign exchange. And I think we can clearly see that the fact that the UTC, or the Greenwich Mean Time as is often referred to, is based in London helps to explain the rhythm as shown on the diagram. So let's supposing now that you are in London, and let's say early in the morning, say midnight going into 1 o'clock London time. This is when traders, for example, in the Asian markets, Hong Kong, Tokyo, etc., are turning up for work. They're starting their day. We can see a movement up in trading. That drops away. And then say starting around 8 o'clock in London, which is when most of the traders, for example, working in the big UK banks start coming on stream. That's when we see a real pickup, a surge effectively in what they call electronic conversations, the amount of trading taking place. That then drops away as the morning progresses in the UK, and then starting at around 1 o'clock in London, which would be 8 a.m. New York, North America, we can see another pickup in trading. It's worth pointing out that, say, at 8:30 Eastern Time, that is when the US government release very many statistics on not necessarily on a daily basis, but on a frequent basis. These include things like the unemployment report or the non-farm payrolls report, all of which tend to have quite an impact on trading of FX. We can see that the activity then continues and then starts to drop away as traders in North America go home, only to pick up again on the other side of the cycle or the daily rhythm here. Now, the point being that, let's say if you are a London-based trader, it is possible to talk to your colleagues, say within the same bank in Asia, when you first arrive at the office, and then as the day goes on, from a London point of view, when people in North America start arriving at their desks, you can carry on a conversation with them. And London conveniently spans effectively most of the 24-hour-a-day cycle that can be seen on that screen. Let us turn now to the major currency pairs. Now, this is also covered in the triennial survey, and we can now see the specific currencies. So, for example, the dollar is involved in around 88–89% of all trades. It does point out down here, by the way, that as two currencies are involved in each transaction, the sum of shares over here will add up to 200%. Now, the dollar, the world's reserve currency, then features in around 90% of that 200. We can see the euro We can also see the difference between the 22 number and the 25 number. Very slight decline there, nothing significant really. We can see the yen. We can see a basket down, as listed down here, of essentially emerging market currencies. They are listed at the bottom. And the trading of the British pound has dropped to 10% from roughly 13 in the 22 survey. And we can see the Chinese currency, the Swiss franc, the Australian dollar, Canadian dollar. I won't read them all out. And with regard to the specific pairs, dollar euro is around 22%, dollar yen around 14%, dollar sterling 7.6%, and once again referring to that basket of currencies, dollar against those currencies is at around 15% as of the 25 data. Now what I want to do now is to go back a little bit in history, which is relevant with any discussion regarding the FX market. Now on the screen you can see this rather beautiful hotel, which is a current picture of the Mount Washington Hotel in Bretton Woods, New Hampshire. Now this was the site of a very significant and important conference that was held, which had a big impact on the foreign exchange world, and where even today there are still remnants of the decisions and discussions that took place at this hotel at the end of the Second World War, 1944. So in July 1944, at that hotel, it was agreed that the dollar would become the world's reserve currency. Delegates at that conference, and you can see two of them over here. This is John Maynard Keynes, the famous British economist who led the UK delegation, and this gentleman's name is Henry Morgenthau. He was the Treasury Secretary of the US at the same time. These were the two, if you like, maybe principal participants in this conference. There were, I believe, around 40 other countries represented at this conference. So the delegates agreed to determine a value at which they would peg their currencies against the US dollar. They agreed to maintain these exchange rates within plus or minus 1% of parity, a so-called band. So there could be very minor fluctuations around these fixed rates, these exchange rates that were fixed. Now, this is quite an important issue. Only the dollar, this was agreed, would be convertible into gold bullion, which was an echo of the previous old gold standard. On August 15th, 1971, the President of the United States at the time, Richard Nixon, unilaterally decided to terminate the convertibility of the dollar into gold bullion, which you recall from the previous slide. This brought the Bretton Woods system to an end. The US dollar, as with all other currencies, became a fiat instrument, because at that point no currency, not even the US dollar, was tied specifically to gold, given the fact that the other central banks around the world could demand that their currency be converted into gold bullion. That brought an end to the idea of any currency being backed with something like a commodity or gold. So all these currencies then became essentially what are called fiat instruments, a term very much used today, for example, by enthusiasts, say, in the crypto world. The era of floating exchange rates began because currencies were no longer pegged. They no longer were fixed essentially against the dollar, and there was a much higher level of variability in the pricing of financial assets. And one could argue that the seeds for the modern age of financialization of markets had been sown. This is something that I've written about in one of the books that I have written over the many years. So, for example, interest rate and foreign exchange futures were introduced onto the Chicago futures exchanges. The London-based offshore or Eurodollar market, as it used to be called, began to flourish. Some have attributed the sustained rise in crude oil during the 1970s, at least in part, which of course was a major contributor to the really rather dramatic inflation problems that arose during the 1970s, even going into the early 80s, some have attributed this rise in crude to the severing of the link of dollar to gold, and financial risk management became a lot more challenging as a result of the increased volatility of currencies and other financial assets. Now, one thing that is quite noticeable in the recent past, as is shown on the diagram on the screen now, the dollar, which, as I say, was established as the world's reserve currency, was, as a part of the FX reserves and bullion reserves held by central banks, was at around 75–80%. That number has been in steady decline going back many years, and we can see here that based on this data that comes from the IMF and so on, that the share of the dollar in terms of these global reserves held by major central banks has declined here from around 58–59% to, we did read this on the left scale, to around 44% as of late 2025 going into 26. Whereas the share of gold in these global reserves, and this can be read on the right-hand scale over here, has moved from around 10% of the total to close to 24% as of the end of 2025. This is a rather significant change in the composition of FX and bullion reserves held by central banks. And this is an example of what is often referred to as the de-dollarization of the global capital markets. What I want to discuss now is the FX carry trade. And what I will do is I will illustrate this by showing you a couple of currencies that are involved in this in a rather dramatic way, but let me at least establish the context. So the FX carry trade can either be seen as a standalone strategy or part of an integrated macro strategy practiced by banks and hedge funds, for example. We take the idea of carry, which is a term widely used in banking, which essentially means what, for example, is the cost of borrowing versus what is the cost that the bank can earn when it lends out money to customers. So carry has that very broad sense, and now we introduce essentially a foreign exchange overlay to this idea. So the carry trade works in this way. Let's say one is a bank or large fund, like maybe Goldman Sachs, and they sell or go short, borrow effectively, a low-yielding currency, such as the Japanese yen, where historically and on a normal basis, the Japanese yen you can borrow at very reduced rates, relatively speaking, as compared to the rates for borrowing in other currencies. So you borrow this large amount, maybe of Japanese yen, then what would happen is you convert it to another currency, maybe the Australian dollar, New Zealand dollar, because over time these two currencies have traditionally provided an opportunity to earn a substantially better rate of interest than the rate that you're borrowing the Japanese yen for. And the motivation is to exploit that interest rate differential, or essentially the carry, as just described. You can hedge the currency exposure, however, based on the way that forward rates and so on apply in the FX market, this actually would diminish this would actually largely diminish the interest rate differential. Often this strategy can be seen as a long-short strategy which expects to gain on one or both of the currency legs. Now let us turn back to this period shown on the screen. This is the period leading up to the financial crisis, starting here in February of 2007, let us say, and this involves the New Zealand dollar against the Japanese yen, which is a good example of the carry trade as being practiced back then in the period leading up to the financial crisis, as I said. So here's how to understand what we see on this chart. We can see that here, this is the rate of New Zealand dollars, sometimes called the Kiwi, against the yen, somewhere around 77 or 78. And this steadily improved here to where the Kiwi had reached essentially 97.7, or close to 98, as of July 23rd of 2007. What essentially was happening during this period was that these funds and banks were buying New Zealand dollars with the yen that they had borrowed as part of the carry trade. This steadily increased all the way up here to where we peaked here at the end of July. Now, during the subsequent 3-week period, this exchange rate collapsed from 98 down to 74. That is more than a 25% drop. The only way this can be explained is that people who were engaged in this carry trade were starting to get really quite spooked by some developments that were occurring in the, say, New York money market and London money market, problems developing in the subprime MBS market, which were obviously precursors to the big drops that we saw in the latter part of 08. So this was a huge drop, completely wiping out the interest rate differential. And just by way of anecdote, during August of 07, so the period on the screen, Goldman Sachs has reported losing more than 30% in one of its funds where it was engaged in the FX carry trade. This is the Australian dollar against the Japanese yen during the same period, and we can see again very similar characteristics to what we saw for the Kiwi, and the drop in this case was around 20%. It was even more acute for the New Zealand dollar yen, as we just saw. To basically highlight why this trade was so popular back in that period, this graphic here, and all I'm going to focus on is this blue line, shows you the spread between the Australian and Japanese 2-year bond yields, which of course is a reflection of the interest rate differential that I have referred to. So during the period in question, this period in, say, mid-07, the spread between what one could essentially borrow in Japan and then earn by having a 2-year Australian bond was up here around 600 basis points. As this trade collapsed, and as we went into the crisis, of course, where interest rates also basically converged during that period, the carry trade opportunity disappeared. Now, if we were to move forward to closer to the current time, say early 26, we would find that the FX carry trade has reappeared, but it very often uses other currencies, maybe than, say, the Australian dollar. It can involve some of the Eastern European currencies, for example. Well, thank you very much for watching that video. I hope you found it useful, and I would like to encourage you to subscribe to my channel, the Corcoran Codex. There is no obligation. You're not required to pay any money to me, but you will then be notified as to when I release new videos, which I do fairly frequently, and all of those videos are centered around the subject on the screen, which is analyzing critical ideas and episodes in the world of global finance.